The last housing crash wasn't just about falling prices. It was triggered by a payment crisis that crushed millions of homeowners. When mortgage rates reset, payments exploded. Homeowners defaulted, were foreclosed on, and home prices crashed 30, 40, 50% or more across the US. Now we're facing a new type of payment shock, not from mortgages and not from rates. This time, it's student loans, and millions of homeowners could soon see their bills jump $600 to $1,000 or more a month. What happens when millions suddenly have less cash to cover their credit cards, their living expenses, food, car payments, and mortgages? This is where the housing market gets vulnerable. Delinquencies will rise, forced selling will increase, and in many areas, prices will fall. And almost no one in the mainstream media is talking about it. But lucky for you, you're tuned into the Housing Nerd channel, and we're going to break it down on today's video. To help us understand more about student loans, mortgages, and how it can affect the housing market, we're going to use a Substack article from John Comiskey. Now, I have John's permission to share this data with you because it's a paid subscription. And I would really encourage you to check out his Substack. He dives into the mortgage market unlike anyone else. So thank you, John, for this information. And by the way, stay tuned to the end of the video because I'm going to discuss how you can protect yourself from being foreclosed on. So comment below, do you have student loan debt right now? And do you have a mortgage? Or maybe you're even struggling to pay that mortgage or pay rent because of student loans. Let me know in the comments below. Now, the name of his Substack article is The Full Intersection Between Student Loans and Mortgages. The article starts out with, mandatory repayment of saved student loans isn't just looming a large payment shock for a big chunk of FHA borrowers, it's looming a large payment shock for roughly 4.8 million loans across FHA, VA, Fannie Mae, and Freddie Mac portfolios when student loan repayment restarts for these saved borrowers in early 2026, assuming the student loan overhaul in the One Big Beautiful Bill remains largely unchanged from how it passed the House. It's unclear how that shock will be absorbed in those households, be it reduced savings investment funds, reduced consumption of goods and services, missed credit card or revolving repayments, missed auto repayments, or missed mortgage payments. But something will have to give. And with wage garnishment in play for defaulted student loans, it's very unlikely to be missed student loan payments. What John's pointing to there is, with student loans, you have to make the payment. If you don't, they'll garnish your wages. The government could garnish your tax return. And so when you have to choose between making a mortgage payment and having your wages garnished if you miss a student loan payment, many people are going to choose to miss the mortgage payment. So now he's going to go into what the SAVE program is, a little background on that. The SAVE, Saving on Valuable Education Student Loan Repayment Plan, was introduced by the Biden administration in August 2023 as a replacement for the REPAY plan, part of a broader effort to make student loan repayment more affordable. SAVE was an income-driven repayment or an IDR plan that bases monthly payments on a borrower's income and family size. Compared to other IDR plans, it was particularly generous. The SAVE program capped payments at 5% of discretionary income for undergraduate loans, 10% for graduate loans, or a weighted average if both exist. It also did not accrue interest if a borrower's payment didn't cover the full interest, and had generous forgiveness terms. So comment below and tell me, do you think student loans should be forgiven? I'd like to know. So many borrowers chose SAVE because it offered the lowest monthly payment. People buy on payment, folks. We all know that, right? It had the lowest monthly payments available and effectively eliminated negative amortization. So basically, unlike the subprime loans we saw back in 2008, 2009, 10, 11, 12, where you could make a monthly mortgage payment, but it wasn't enough to cover the interest payment. So the loan basically grew, the principal grew, the outstanding debt grew. With this SAVE program, they eliminated that. So you could basically make a small minimal payment and your overall balance wouldn't increase. The problem was the plan was legally enjoined in July of 2024 after multiple states challenged the administration's authority to implement such a sweeping change to IDR plans without congressional approval. That injunction was affirmed earlier this year. As a result of the injunction, saved borrowers were placed in administrative forbearance. There's forbearance again, folks. Just like with mortgages and forbearance, they have student loan forbearance. So the borrower didn't have to make monthly mortgage repayments as the courts sorted it out. To be sure, these saved borrowers were subject to repayment for the roughly 9-month period between the student loan resumption in October 2023 and the save injunction in July 2024. And even with negative consequences of non-payment, collections, credit reporting, etc., suppressed during the 12-month student loan resumption on ramp-up period, many likely were, albeit and importantly, at the much lower payment amount of the SAVE plan. As of March 31st, 7.84 million borrowers were still in SAVE forbearance. And this part's important, folks. In effect, the income-driven repayment plan shifted the question from how fast can I repay these student loans to how little can I pay on this loan before it's forgiven. As a result, these plans often made the most sense for mortgaged homeowners who also carried large student loan debt, and not just FHA borrowers. Indeed, the student aid government data as of March 31st bears out that the SAVE plan and all income-driven repayment plans in general carried high student loan balances. Take a look at this information. This is crazy. So here on the left-hand side, you'll notice here are all the repayment plans or the type of repayment plan. And then this next column is the outstanding dollars in billions per plan total. So the SAVE plan right now has $439 billion in debt, basically the balance. The recipients, there were 7.84 million recipients of the SAVE plan, and each recipient, the average loan balance is $56,084. Comment below if you have student loans, what's your balance, higher or lower than 56 grand? So you can see the people in the current income-based repayment plan, $137 billion. There's 2.81 million folks with that plan now. They have an average balance of $48,897. But the one that you really want to pay attention to is this SAVE program, the 7.84 million borrowers. Let's take a look at that more in a minute. So now John's going to go into what portion of current FHA, VA, conventional borrowers have student loan debt. And then he goes in and figures out what's their current monthly student loan payment now and what will it be when this SAVE program ends. And so I'm going to skip down because his methodology will make your head spin. It's awesome he put it in here, but probably too much to share with you right now. Again, you can check out his Substack and read it for yourself. But I'm going to jump to the good stuff. So using his methodology, John says that the FHA borrowers out there, there's 8 million current FHA loans, 2.4 million with student loan debt, 1.52 million in the SAVE plan. For the VA borrowers, 3.7 million total loans, 0.89 million with student loan debt, and about 500,000 in the SAVE plan. Then he adds in the GSEs or the government-sponsored enterprises. And that's basically conventional loans. And there's actually two, Fannie Mae and Freddie Mac, which have 15 million loans each, or 2.55 million with student loan debt and 1.35 million each in the SAVE plan. So you add all that up and you've got 41.7 million loans total, 8.4 million with student loan debt, and a whopping, are you ready for this? 4.8 million borrowers in the SAVE program currently. And those borrowers are the ones that could have massive payment shock. How big is the payment shock? We're going to look at that next. Calculating the payment shock. The payment shock that will hit the SAVE plan loans needs to be expressed as both the full payment shock as well as the payment shock over SAVE. So he's going to show us, hey, this is what the payment is now that people are having to deal with, and then what's the increase of their monthly student loan payment once they come out of the SAVE plan into the normal income-driven repayment plan. The full payment shock is the increase from what the borrower in forbearance is paying, which is zero, and what the borrower will be paying under the new IDR plan when they are transitioned over to it. The shock over SAVE is the new IDR payment amount less the SAVE amount the borrower was previously expecting to pay and may have been actually paying from September 2023 to July of 2024. Those average payment shocks for each portfolio are: for FHA, average full payment shock $520 a month. Shock over save plan $375 a month. Average student loan balance for an FHA borrower, current homeowner, is $53,646, meaning these FHA borrowers were basically making like less than a $200 payment every month on their student loans. And now they'll have to make a $520 payment, which is an increase of approximately $375. What about VA borrowers? Average full payment shock $694 a month. The payment shock over the save plan $471 a month. Average student loan balance $68,117. So these folks were making a little over a $200 payment on average, but now they're going to have to make a $694 monthly payment. And then we've got Fannie Mae, average full shock $1,019 a month. The shock over the current save plan $645 a month. Average student loan balance, are you sitting down? $100,814, over 100 G's in student loan debt on average. And now they're going to have to make a payment that's increased by $645. Average, they're paying $1,000, over $1,000 a month, basically. Then we've got Freddie Mac. Average full payment shock, $988 a month. Shock over the save plan, $629 a month. Average student loan balance, $97,000. Now, he points out that since the new IDR payment plan, as well as the save payment, are heavily dependent on borrower income, the payment shocks are smaller for borrowers with smaller incomes and larger for those with larger incomes because it's tied to your income, not necessarily how much you owe. So what does all this mean? How's it going to play out? Like, what happens next? As a reminder from the prior post, once the big, beautiful bill becomes law, and of course, assuming that the student loan overhaul within it is largely unchanged, or the loan repayment portion of it stays the same, the timeline starts. As required in the legislation, all existing income-driven repayment plans, including SAVE, must be converted to the new IDR plan within 9 months. Given the time required for rulemaking and servicer implementation, the actual repayment requirements for SAVE borrowers likely won't hit until the end of that 9 months. So, in the first few months of 2026. So basically, that means around mid-2026, we're probably going to see a lot of these student loan borrowers who have mortgage payments start to default. I mean, if they're struggling making their student loan payment now, once it doubles in size, forget it, right? Probably definitely going to have to forego some type of expense in their life. And a lot of them may not be able to pay their mortgage. They may also not be able to pay their rent. And so we could see an increase in foreclosures, maybe at the end of 2026, going into 2027. So right now, this is what foreclosures look like. And this chart is courtesy of Resi Club Analytics. The links for this is in my description as well. And this shows us the U.S. housing foreclosures by quarter. And if you go back to 2009, you can see over 500,000 foreclosures in one quarter. And that obviously has dropped substantially during COVID because of extend and pretend, just like with the student loans. The government said you don't have to make your mortgage payment. I've got tons of videos on my channel about that, but people weren't making their mortgage payments. They didn't have to during COVID, and the government wasn't foreclosing. So there were really no foreclosures at all happening. But then it's steadily increased, and now we're basically, around 50, 60,000 foreclosures right now in quarter one of 2025. And so those two things, you've got the student loan forgiveness and the mortgage forgiveness are both ending, and they could converge at some point in 2026, 2027, and you're going to see a large wave, I would think, of mortgage delinquencies and probably foreclosures. So now let me give you 3 ways to help avoid foreclosure if you get into trouble with your student loan payments or just can't make your mortgage payment in general. Number 1, contact your loan servicer early. The sooner, the better. Don't wait until you're 30, 60, 90 days behind. When you sense you can't make a mortgage payment for the month as it's due, contact your loan servicer immediately. Now, number 2 is explore the options available to you from your loan servicer when it comes to forbearance or mortgage modification, because there are programs in place to genuinely help people when they need it. Now, number 3 is sell before it's too late. In other words, before you destroy your credit, consider selling your property, especially if you have equity. Now, it doesn't make sense every time to sell it, but if you have equity and you can walk away with money in your pocket, avoid destroying your credit, a lot of times that can be a great solution. Many people don't want to do that. They want to stay put. They don't want the hassle of moving or admitting to themselves that they can't make the mortgage payment and they don't want to sell or go through the hassle of it. I totally get that. But that's much better than destroying your credit and going into foreclosure, or heaven forbid, not making your student loan payment and having your wages garnished. Now, the fourth thing you can do, and this is for folks that are considering purchasing a home right now, is make sure that you have an ironclad understanding of the money it's going to take and the monthly budget to buy the house. If you just blindly walk in to buying a home right now, especially if you have student loan debt, you can set yourself up to get creamed. So get with a mortgage professional that can help you understand what it really costs to own a home. Do research online. Take home buying courses. In fact, there's a gentleman, Travis Spencer, who has a YouTube channel, Real Estate Mindset, and he has a home buying course that I would highly recommend, and it's free. The link for that's in my description below. Another thing you can do to help you make your mortgage payment is consider taking in a roommate, or maybe even Airbnb-ing a portion of your property. If you have extra bedrooms, extra bathrooms, or an in-law suite, or a finished basement, it could make sense to try to rent those things out to someone who needs a place to stay and have that help make your mortgage payment or student loan payment. But I'm really curious on what you think about this article from John. Do you think student loans will cause a lot of distress in the housing market? Do you think the government will come in and save everybody again? No pun intended. And just kick the can down the road? I'd like to know in the comments below. Now, do me a favor, subscribe to The Housing Nerd if you got any value out of today's video. Hit the like button. It really helps me out. And share the video. But whatever you do, I want to hear from you. Don't forget to comment below. Now, YouTube thinks you'll like this next video from me.